The difference over stable coins is the yield, and yes, stable coins with yield are coming, but the difference with money market fund, it doesn't have to be in treasuries.
That's right.
It can be in a range of yielding assets. So there's usually a yield pickup, is that right? Versus holding it directly at a bank or even the treasury market. That's a monstrously large market. It feels like it's a much more efficient way of doing it. Just the yield, because things get stuck in the financial system and some people capture the yield, others don't. This makes it much more efficient. It feels like it's pretty obvious that this is where it's going. But what struck my interest is if you're offering the same to individuals, why do they need a bank?
Hey guys, welcome to Everyday Finance. After reaching a high of 123,218 yen in the previous week, Bitcoin is consistently trading above 118,000 yen. This narrow trading range indicates that there is a period of calm before what may be a significant move. Following the passage of the GENOS Act, which was agreed upon by both parties and signed into law by President Trump, the White House will publish its first formal report on virtual asset policy on Tuesday. A comprehensive regulatory framework for stablecoins has been established by this new law, which mandates that full USD reserves be held and that stringent AML compliance be maintained. There is a possibility that it may solidify the United States' position as the global leader in crypto legislation. In addition, the executive order issued by Trump prohibited the establishment of a CBDC in the United States and established a working group with the objective of developing a national digital asset reserve. These actions indicate that the administration is strongly in favor of Bitcoin.
How do you deal with it without having your hair on fire all day, with prioritizing what you want to do at Franklin Templeton? What are the things that really matter for you guys versus the generalized, everybody's doing something, so it has a feeling of, oh my God, we need to do everything. What are you focused on? What are the core priorities for you guys right now?
So we've been very lucky, Raoul, in that we saw this coming for quite some time, and we have been diligently building out our infrastructure. So I think unlike many other players, we have an infrastructure that has been custom built to operate in this new ecosystem. And the functionality that we have built, I think, positions us to act like a digital native while being a traditional financial firm. And that creates great opportunity, right? So if you think about our priorities are, really using the tokenized money market funds we've created globally that are available globally as rewiring the way that collateral works and the way that people can move seamlessly between stablecoins and tokenized money market funds. And then you need to go back to your core principles. Who are you, right? We are an asset manager. And so this opening up of the real world asset opportunity has really created, I think, a great potential for us to really start to migrate our investment portfolios into these new rails and into these new audiences, and do so in a way that is in line with where the industry is today, which is very personalized, very flexible portfolios, not traditional standard 60-40 portfolios, but really rethinking what does direct indexing look like in a tokenized world? What does personalized and customized tax optimized solutions look like in a tokenized world? And I think that is where we're going to leapfrog to. I don't think it's going to be individual equities. I don't think it's going to be ETFs. I think it's going to be, how do you use these new rails and new wrappers to create portfolios that really are 21st century portfolios, not 20th century portfolios.
So to address the first part of that, the money market funds, who are the users of these and who do you envisage onboarding in the money market funds? These are, I guess, wholesale products for institutional players, or does it go down to retail level? What is the big picture thinking with the money market funds?
Yeah, so there's a couple things there. For, I think, the institutional marketplace, this is clearly a alternative to using stable coins for global cross-border trade, because you get both the programmability of the token wrapper to be able to use in a tokenized fund, and you get the yield that comes with the fund natively, right? So we see this as a great alternative, perhaps a superior alternative to stablecoins for cross-border trade, all sorts of trade financing use cases, supply chain use cases, shipping use cases, right? Treasury use cases, all of which, are going to be enabled because these new rails offer new capabilities. So we, for the first time, are able to upgrade the way that a money market works, right? We are able to do a second by second shareholder record. And therefore, if you hold assets for just 2 hours and 32 minutes of the trading day, you can get 2 hours and 32 minutes worth of the trading day's yield. Whereas today, you would not get any of that yield unless you were holding those positions at the close. We're able to pay out that yield every single calendar day, including Saturdays, Sundays, and holidays, because we're doing it through incremental issuance of new tokens, and the token is our digitally native exposure to the fund. So we're able to give you more cash certainty and see that cash yield being distributed daily rather than monthly, which is the case with most money market funds. So I think that these abilities, along with the peer-to-peer transferability of our tokens, is what's really going to reposition these money market funds for an institutional audience. But what's really cool with Franklin Templeton is that we also have tokenized our 40 Act retail fund and delivered it via an app, right? And so any individual in the US can sign on and they can trade amounts as low as $20 in our tokenized money market fund. And we've built the peer-to-peer transferability so that you can use it just like you would use Venmo. You can transfer your money market fund shares as payments between accounts with your friends. You can use it in any way that you would any other type of cash management account, yet you get the yield on all of those transactions. So we're both excited for the retail opportunity of really expanding the set of tokenized instruments that you can use to improve your own finances, and for the institutional use cases.
The difference over stablecoins is the yield, and yes, stablecoins with yield are coming, but the difference with money market fund, it doesn't have to be in treasuries.
That's right.
It can be in a range of yielding assets. So there's usually a yield pickup, is that right? Versus holding it directly at a bank or even the treasury market.
Yeah, there's a yield pickup. There's a repo opportunity in there. So you can get a little bit of extra fee through the repo opportunity. And there's also, I think, the regulatory protections that you get by using a registered fund as opposed to this new type of cash instrument where the rules are still being set, the reserve pools are less certain, the transparency is not as clear, and the fees that are sometimes hidden in these funds, particularly for institutional users, are not transparent. So I think that there's a number of advantages to tokenized money market funds. And then if you look at MiCA and you look at the Genius Act that just passed in the US, they specifically forbid stablecoins from paying out yield. So I don't know how quickly yield-bearing stablecoins are coming in regulated jurisdictions. And there is likely to be much more of a KYC AML component to stablecoins, which could really begin to curtail some of their use because the issuers and the managers of these stablecoins are not really the entities able to perform that KYC AML. So I think that there's, I think stablecoins have been an amazing bridge to the new future, but I don't know if they're going to be quite the same killer app that people thought at one point.
Bitcoin is experiencing a surge in demand from institutions. Just in the past week, spot Bitcoin exchange-traded funds ETFs, located in the United States, pulled in a total of $2.39 billion in inflows. As Bitcoin BTC continues to move closer to the 120K level, many people believe that a new all-time high may be on the horizon. The broader market is keeping a careful eye on the situation, particularly because stablecoins that are backed by the USD account for more than 99% of the global supply. It would appear that the United States is well positioned to take the lead in the battle for digital assets, not just through regulation, but also through strategic accumulation and the construction of infrastructure.
Just so people understand this, how big is the money market fund market?
So just in the US, the money market fund is $7 trillion in money market funds in the US alone, right? So, I mean, we're talking a tremendous market here when you think about the opportunity space, right? And that's today with them just basically being used for institutional use cases. This is before we open up all these new use cases.
That's a monstrously large market. It feels like it's a much more efficient way of doing it. Just the yield, because things get stuck in the financial system and some people capture the yield, others don't. This makes it much more efficient. It feels like it's pretty obvious that this is where it's going. But what struck my interest is if you're offering the same to individuals, why do they need a bank?
Well, this is one of the intermediaries that I think have to really seriously rethink what is their role in the emerging economy. First of all the banks today are account-based. Not a single bank that we know of offers a wallet-based system to manage exposures, right? So they're going to have to retool dramatically to be able to compete in this space. Most banks today are looking to tokenize their deposits or tokenize their liabilities, which is basically locking in their account-based structures. This feels like a very defensive play, right? This is not really thinking about the native rails that you can build upon and re-envisioning what your products could look like if they were running on native rails. And because of that, you don't get the same utility out of these assets that you would get if you had a digitally native instrument. And this is what we're already seeing with money market funds. I mean, plenty of people have tokenized treasuries or tokenized money market funds, but they're not really utilizing the native capabilities of the rails because they're still settling those securities in the off-chain system. We're among one of the only firms globally that has been able to build an on-chain system that our entire set of books and records is on-chain. So we're able to operate at the speed of digital rails, whereas many others are really waiting for that 24-hour or longer settlement window to pass. So I think that there's, I think understanding of the nuances of the products that are in market today are going to become more clear over the coming months, and the advantages versus the disadvantages of these different tokenized money market funds will become easier to understand because they're really not all the same, right? There's very significant differences in the products in the market.
And how do you onboard clients? So it's all well and good building a great product, but how do you get clients to do it? Because they need to understand wallet experiences, the new way of settlements. They've got to get their systems working. How's that process going?
Well, what's been super fascinating is that it's actually coming a lot to reverse inquiry, right? Like I think that these particularly corporate treasurers and sourcing officers really understand that if they can get into stable coins and tokenized money market funds for cross-border trade, it removes tremendous layers of fees and tremendous delays in the way that they can receive and disperse capital. I think that they're starting to really even front run where the financial markets are in terms of looking for these opportunities. And because these systems are being built from scratch, like we built our system from scratch at Franklin Templeton, it's entirely API enabled, right? So we have already done test cases where we have built our system into enterprise resource management software, and they've been able to run their enterprise resource management software straight through using our API without having to do any real retooling to their reporting or payment systems. So it's pretty interesting what you're able to do because of the way that these new technologies are being architected.
So let's talk about the second point that you raised earlier, which was about construction of portfolios, because this is an interesting thing. How do you envisage it's going to change? Right now we have, whether it's wealth management firms or advisors, whatever, or ETFs and direct access, kind of plain vanilla products. Everything else you can't really get access to unless you're a high net worth. What is in your head where this is going?
Yeah, I think that, you've started to see this shift in the US from obviously standard funds that you would put together 5 or 6 or 7 different funds to have a portfolio, to a model portfolio where you basically have a recipe that has all the components of a fund in it in the correct measurements for how you put one portfolio together. to direct indexing, which is basically taking the holdings of ETFs or other investment funds, looking through to the underlying securities that sit in those portfolios, and then optimizing them for the individual. And those optimizations are pretty basic right now, right? I work in a financial services firm. I used to work in a bank. I might not need as much exposure to the financial sector in my portfolio because the way I get paid, I have a lot of exposure to that sector. So they can dial down my exposure to the financial sector in my portfolio. And they can look at all of my positions in my portfolio, and they can optimize my tax situation by looking at my tax lots and actively managing my tax lots. So it's a pretty basic set of personalizations, but it is at least trying to tune the portfolio to Sandy, not give me a generic portfolio. This is tough to do in the markets today. I need to be able to deploy an entire system of separately managed accounts. I need to build specialized software that can really take in and analyze all of these different positions. I need to connect it into the technology that these brokerage houses have built, and these wirehouses and wealth management platforms have built. I need to be able to automatically rebalance all of these positions, right? It's a lot of tech-driven lift into systems that are old and all mainframe based, right? If you think about taking the concept of what they're trying to do, looking at each individual holding in a portfolio and optimizing the way that it's being utilized, this translates really well to the blockchain-based and wallet-based ecosystem. We're already, right? We're already seeing, we saw the announcement of Robinhood about their launch of their new platform in Europe, where they're going to be offering tokenized securities and tokenized ETFs, right? This is going to happen faster and faster.
This time around, Michael Saylor is driving optimistic enthusiasm with a straightforward post that reads, "Stay humble, settle the sats," its remark. In conjunction with a chart that displayed Strategy's current holdings of over 601,550 BTC, which is equivalent to over $71 billion, caused a great deal of speculation. Historically speaking, these posts frequently come before significant Bitcoin purchases made by the corporation. Companies that are listed publicly currently have a total of more than 860,000 Bitcoins, the Strategy continuing to be the top holder by a significant margin. The buzz on social media suggests that Bitcoin may be getting ready to make a push to $200,000. Saylor's strategy, she refers to as the Bitcoin yield loop, continues to be extremely successful. This strategy involves raising capital through stock offerings or convertible notes during bull runs in order to purchase further Bitcoin. The Saylor effect is definitely in full force, as evidenced by the roughly 15% increase in Strategy stock over the course of the past month,